All right, Tom, we're recording. Hello, everyone. Welcome to our webinar hosted by the MHP Pros. On behalf of Hall CPA, we have Thomas Castelli here with us. Thomas has done a number of webinars with us. Previously, he has been a wealth of information on not just mobile home parks, but all real estate tax related topics. We're really excited to have Tom back again today. I'm going to give Tom the mic now to just introduce himself, talk a little bit about what he and his firm do, and then jump into our topic today, which is the three biggest year-end tax items to consider as we go into the new year. So, Tom, I'll kick it off to you. Thanks again for being here.
All right, thanks for having me, Mike. So my name is Thomas Castelli. I'm a CPA. I've been in a CPA for the last 10 years, and I'm also a real estate investor myself. Primarily at this point, I do mostly syndicates and funds as a limited partner, but I was part of a syndication of an 82 unit apartment complex a few years ago, which we took full cycle, and now I've just been focusing on the CPA firm for now. But yeah, so I've been advising clients on how to reduce their taxes through proactive tax strategy and planning since I started doing this in 2018. And our firm, Hall CPA, we work with real estate investors, high income earners, and small business owners across the United States. So we have clients in all 50 states at this point, and we help them reduce their taxes and gain financial clarity with proactive tax strategy and planning, tax preparation, filing, and accounting services. So within that, we have clients of all different types of asset classes within real estate, including mobile home parks. So today, I believe we're going to be speaking on the top three year-end things that you need to be aware of as we kind of head into the year end here. And there's a lot of things, a lot of year-end opportunities, but the top three things that we need to be mindful of as in real estate investors overall, including mobile home park investors, are going to be the property's place in service date, especially for any acquisitions that are taking place here at year end. The real estate professional hours, if you're going to be trying to qualify as a real estate professional. And then finally, any year end expenses or capital expenditures that you're trying to get in before the end of the year to, maximize your deductions for this current year. So let me just kick it off with placing the property in service. So I've been speaking with a lot of real estate investors over the last 2 or 3 months, including even up until today, who are closing on properties late in the year. There's something called the place in service date. So the date a property is placed in service is the date that it's rent ready and available for rent, which typically means it's listed, it's everything's in rental order and it's listed for rent. If you're acquiring mobile home parks, most of the mobile home parks I see are not completely vacant. I'm sure that they exist, but they usually have some type of renters already on that. So if you're buying a property, whether it's a mobile home park or whether it's another type of investment property, and you have a tenant or tenants in there day one, it's also considered a place in service. So why is this date important? Because the date you place the property in service is going to be the date you can start depreciating it. And with depreciation comes the eligibility for bonus depreciation. And with 100% bonus depreciation being at 100% for assets acquired and placed in service after January 19th, 2025, that is substantial. And it's even more compounded the fact that mobile home parks can sometimes have 70% or more of eligible property in bonus depreciation because mobile home parks tend to be predominantly land improvements. And then even the mobile home parks where you have park-owned homes, if they're not permanently affixed to the ground and they are movable, then they are considered 5-year property and they're eligible for bonus depreciation as well. So the place and service date is critical, uh, especially if you're trying to maximize your depreciation for 2025. So all this to say, let me wrap this up with the place and service. If you're acquiring a property in Q4 or even as late as some point here in December, and you're hoping to use it as, for bonus depreciation in 2025, it needs to be placed in service. Again, it's placed in service when the property is rent ready and available for rent, so it's listed on the marketplace, or you already have somebody renting out the property in a mobile home park. That could very well be the case. So that is important if that's what you're trying to do. Okay. The next thing is going to be real estate professional status. So the real estate professional status. So let me back this up. And I've probably talked about this here, with mobile home park, with the MHP Pros in the past. But real estate is passive by default. And what does that mean? That means that any losses that are generated from the property, typically through things like bonus depreciation, are only going to offset other passive income, which can be passive businesses you may own as a limited partner or that you're no longer actively involved in, or typically other rental properties for most real estate investors. So, so the real estate professional status, what that allows you to do is allows you to take the losses from your rental properties, including mobile home parks, against your W-2 or your active business income. Now, if you have a high W-2 income earner, if you are, I see the question that's popped up. I'll address that in a minute. If you are a high income W-2 earner and you work full time, chances in anything other than real estate, then chances are the real estate professional status will not be on the table for you. However, if your spouse qualifies, if your spouse is able to qualify as a real estate professional and you file a joint tax return, or then you are able to tap into that real estate professional status, or vice versa. If you're the real estate pro and your spouse is a high income earner, same thing. So to qualify as a real estate professional, you do need to spend more than 750 hours and more than 50% of your total working time in a real property trader business. So that could be brokerage, that could be your mobile home parks, that could be a whole host of different real property trades or businesses. But just know that in order to meet that requirement, you need to spend more than 750 hours and more than half your total working time within the calendar year. So the calendar year is from January 1st to December 31st. And you need to be able to prove, if you're ever audited by the IRS, the burden of proof is on you to prove that you met those requirements. So not only do you need to meet those requirements, but you also need to document your position. You could use a spreadsheet or you could use a time tracking application like a Clockify, like Reps Hour, like a Reps Log. There's a whole host of them out there that you can use to track your time, but you want to track that. So to tie this together, the reason why this is important is because if you want to take the losses from your mobile home parks against your active income, whether it's business income or W-2 income that either you or your spouse are generating, you need to have the reps, right? And then the placing in service, if you're trying to do this at the year end, like a buzzer beater, you need to make sure that your mobile home park, if you did acquire it close here to year end, is placed in service to tap into that. So before I get to the third one, final expenses and CapEx, I see a bunch of questions kind of coming in here regarding this. So I'll go ahead and I'll address those right now. So we have one from Sergi. For a high income W-2 earner who's a passive LP, so they're investing as a limited partner in a mobile home park syndication, how would you explain the real tax benefit of cost seg and bonus depreciation in terms of what it can shelter today for a hypothetical acquisition in 2026? And and what happens to depreciation recapture at sale so we don't accidentally overpromise what will be offset with their W-2 income. So if you're investing as a limited partner in a real estate syndication, and you're not a real estate professional, meaning you're not a real estate professional from your own direct holdings, you're just a limited partner. I'd say you just put 50K in an investment and you work full time, right? Let's just say that's the person's profile. The losses, any losses generated from that investment for that limited partner will not offset their W-2 or their active business income. It's not on the table for them. And that's the case for most LPs. Most limited partners will not be able to offset their W-2 income with the losses from their syndication investments. That goes for mobile home parks or goes for really any syndication. Okay. What it will do for them is any income that's being generated by the mobile home park investment itself, or the income generated, the rental income that you're receiving from the mobile home park, will typically be sheltered from tax thanks to depreciation, meaning they're not paying tax on that cash flow or that rental income that may be being allocated to them. They're not paying tax on it. So that's important because if they're a high income earner and they have a W-2 job and they're paying tax at the 37% tax rate, being able to shelter their rental income using the losses from depreciation is beneficial in and of itself because rental income, if there was no depreciation and it was taxable, is also taxed at 37%. So they're shielding their rental income or the cash flow from these investments from tax. Regarding depreciation recapture, the way depreciation recapture works is that there's a tax on any depreciation you took during the life of the deal. you have to pay tax on that when you do sell. Depreciation recapture is typically taxed up to 20, up to a max of 25% for straight line depreciation, but any bonus depreciation is taxed at ordinary rates up to 37%. So that's kind of how it works if you're an LP, right? If you're an LP, you get the benefit of shielding your income today, and then also, by the way, it could not only shield the income from that LP investment, but could also shield the income from other LP investments that they might be invested in. And also, if they sell, if it, say they have a syndicate they're involved in and it sells and they have a massive capital gain, whether it includes depreciation recapture or not, those losses can also help offset those capital gains on sale. So happy to take follow-up questions there, but long story short, the big bullets for high income W-2 earners who are passive LPs, no, not offsetting the real estate professional status. Okay, it's not offsetting the real estate professional status. It's not offsetting. It's only able to offset their other passive income. So, how do you materially participate? It's a question for Miguel. So, material participation is, in a big blanket terms, I'll break down some of the nuances. But in an overall blanket, material participation are the activities, the actions, the things that the tasks, however you want to look at it, the things that you're doing within your rental properties or mobile home parks that are material to the operations of the business and typically include things that you find a property manager doing. For example, things that typically count for material participation is listing the property for rent, showing the property for rent, coordinating repairs for maintenance or capital expenditures with contractors, doing the repairs and maintenance yourself, collecting rent, evicting tenants, making sure that inspecting the property, making sure it's rent ready and things are operating properly. Things that are basically, if a property manager is doing it, chances are it's going to qualify as material participation. Conversely, what doesn't count as material participation, it would be um, investor level hours. And investor level hours can include things like searching for properties on Zillow, searching or LoopNet or wherever, like just looking for properties. That does not count as material participation. General research on markets typically does not count as material participation. If you do have a property manager, so if you do have a property manager, things that don't count towards material participation are going to be bookkeeping, handling the finances, taxes. That stuff typically does not count. Education time does not count towards material participation. So for the most part, generally speaking, unfortunately, sitting here on this webinar today is not going to be considered material participation. Material participation in a nutshell, again, just to give it one big lump sum, are activities that are involved in the operations of your property, which are typically duties that a property manager would handle. Um, so Stephanie asks, if you can't qualify as a real estate professional due to full-time W-2, can you qualify under the active participation rule? So I believe I know what you're referring to. You're referring to what's known as the special loss allowance. The special loss allowance requires active participation, not material participation. And active participation is simply defined as making any decisions within your business, within the rental property. So, for example, making a decision to hire a property manager or approve certain expenditures over a certain amount, that is considered active participation. It's a much lower bar. You typically need to own 10%, and LPs cannot qualify for active participation. You have to be actively involved. So LPs, you're typically not getting active losses. But the special loss allowance, if you qualify for that, can allow you to deduct up to $25,000 of rental losses against your active income, as long as your modified adjusted gross income, or your MAGI, it's sometimes called, is less than 100,000. Once your MAGI it goes over $100,000, that deduction begins to phase out $1 for every $2 of modified adjusted gross income until 150,000. So to give an example, if you had $100,000 or less in modified adjusted gross income, you could deduct up to $25,000 in rental losses. Okay. If your MAGI is $125,000, for example, well, now that is cut in half. So now your deduction is maxed out at 12.5K, 12,500, because it phases out $1 for every $2 above 100,000. Now, once you hit 150, the deduction is completely eliminated and you don't get anything. Unfortunately, this has not been adjusted for inflation since it's been introduced back in the 80s or the 90s, and it's unfortunate that it hasn't. Me and some of our team members did an inflation adjustment that if it was adjusted for inflation, that it would be very substantial. I think the deduction would be up to like 70K today, which is pretty substantial. And for many would not need the real estate professional status anymore. It would still be highly relevant, but it wouldn't be as necessary. Unfortunately, it's not, and it's capped at 25K. Um, yeah, so that I'm happy to keep going with questions, but the final one, the final most important thing is getting in any year-end capital expenditures, any year-end equipment, any final expenses that you want to pay here in the year end to get those as deductions, right? So what happens is like and what I mean by that, let me give you some examples, right? Say you wanted to buy a new computer or you wanted to buy a new vehicle, or you wanted to buy any new supplies or just basically anything that you would be using in 2026, rather than waiting until 2026 to buy those things, buy them now at the end of the year, and those will become deductions this year. So you see a lot of people accelerating their expenses again, like common things you'll see, vehicles, computers. Those are just two things that come to me to mind that I see people would buy in this situation. Um, Also, prepaying certain expenses. You can prepay expenses as long as you're going to use them typically within the next 12 months. So, for example, you may want to prepay insurance. You might want to prepay certain taxes. You might want to prepay um, just other expenses, maybe subscriptions and dues and other things, professional organizations that you might be involved in, because you can deduct them here in this year, getting that deduction. Um, that's the third thing, and a lot of people ask about that, like, what can I do before this year end? What can I buy? What can I do? And just accelerating those expenses, bringing them from 2026 into 2025, will go a long way in helping you knock down some of your taxes. So those are the top three things. Again, I'll summarize that. It's going to be placing any properties into service by year end if you do want to take advantage of the depreciation benefits of that property in 2025, assuming it's not already been placed in the service. Because if you place it in service in 2026, now we're looking at 2026 and you're not getting those benefits in 2025. Second thing is going to be making sure that if you are looking to qualify as a real estate professional, that you do fully meet the requirements in the calendar year 2025 and that you're documenting your position to not so that you can not only take the tax benefits of the real estate professional status, which are often driven by losses on properties by depreciation, but also that your position is defensible. Believe me, you don't want to be trying to make up your time log 2, 3 years down the road if you're ever audited, trying to remember what you did back in 2025 and now it's 2028. I used to have to track my time as an accountant. I can barely remember what I did 2, 3 days ago with any specificity. So it's just challenging to do. And then finally, accelerating any expenses or capex that you might be considering in 2026, bringing them into 2025 to get those deductions. Last bonus tip I'll give, and I know this might be some LPs out there thinking, as an LP, if you have any gains from the sale of rental properties you own or syndicates that have been liquidated or sold during this year, you could also make LP investments towards the end of this year to go ahead and offset those gains if you've not already done that. The one caveat I would mention is A, make sure they're using cost segregation studies they plan to for 2025, and B, don't let the tax tail wag the dog. Make good, solid investment decisions first and foremost, and let the tax benefits just be the icing on the cake. There's no use to throwing good money out the window into an investment that's not going to make sense economically or from an investment perspective, just to get some tax benefits. It's usually not a good decision. So those are my three number one tip, my three tips, plus the bonus one there. Happy to take more questions.
Yeah, I wanted to ask a question on behalf of everyone as well. So you mentioned investing in potentially property, plant, and equipment, obviously other operating expenses ahead of time, and then potentially doing some CapEx items prior to year end. What would be the tax treatment of those specific expenditures over the course of, is that then depreciated on the same schedule, or can you capture the 100% bonus depreciation on
Yeah.
those items given they are capitalized?
So it depends on the type of expense or capex. So general expenses, for example, if I prepay insurance for the next 12 months, that's just an expense. That's not depreciated. There's no depreciation recapture. That's just a normal operating expense. The difference is I'm not paying it in January or February, whenever. I'm just paying it in December. So those type of true expenses, they'll just become immediately deductible this year, and you're good to go. Now, capex, it depends on the depreciable life of the capex. If it's a computer, for example, that is typically considered 5-year property. But because it's 5-year property, it's 100% bonus depreciated. One more thing I would say, there's something called the de minimis safe harbor, and I should have probably mentioned this before. It's the de minimis safe harbor. It allows you to deduct costs, expenses, even capex, as long as it's $2,500 or less, so 2,500. So, for example, if you bought a computer for $1,900, that's normally considered a capital expenditure and has to be depreciated. But because it falls under the de minimis safe harbor, it's just immediately deductible. There is no depreciation recapture. It's just deductible. So those types of minor capex you could do. Anything that falls into that 5 or 15 year bucket would count. So those types of renovations or those types of capital expenditures would be eligible for 100% bonus depreciation, assuming they're not eligible for the de minimis safe harbor because they're too much. So those are the type of things you want to just be mindful of. Most land improvements or landscaping, things that you might be doing to mobile home park, if they're having to do with work that's done to the grounds, there's a good chance they qualify as 15-year property and are going to be eligible for 100% bonus depreciation. 5-year property, those are things like fixtures, faucets, carpeting. I don't know how relevant those are going to be to most mobile home parks, but there are certainly other 5-year property that you could find if you're going to make those and accelerate those if you wanted to.
Yeah, and we can generalize to more than just mobile home parks here. I think we have quite a large audience from a bunch of different asset classes. So we have multifamily on here, we have single
Mhm.
family as well. So that's fantastic to note. And then also, you mentioned placing in service date, before the 31st, which I think is extremely important. Just to clarify for those individuals who might be trying to get a cost seg done, before the tax date, you can have a cost seg done post 12/31 as long as that property's been placed into service pre 12/31. Is that correct?
Yeah, you could do a cost segregation study after the year ends. It does not have to be done before the year end. The place in service date is just the critical component because that's the date that that property is going to be considered placed in service for the first time for bonus depreciation purposes. But yeah, cost segregation studies, you can do those up until you file your tax. You just need to have the report ready to go with your tax return. So that just comes down to coordinating with a cost segregation company in terms of how long it's going to take them to get it done for you and making sure you do that with enough room to give your CPA or whoever's preparing your taxes, giving them that report that they could put on your tax return.
Great. Thank you so much, Thomas. I'll let you take some more questions and comments from the group here.
Okay, we got one from Miguel. When considering usually a depreciation of the improvements of building being the biggest write-off amounts, how will mobile home parks compensate this? Um, I'm not sure that I'm not sure that I understand the question, Miguel.
Miguel, I can bring you to the stage if you want to ask it live. Just tell me if you're willing to do that, and I can pull you to the stage here. Miguel, I've made you live. You can unmute and ask the question live if you'd like.
Hey guys, thank you,
Hey,
Michael.
Miguel, how are you?
Thank you so much for bringing up. The question will be, I was trying to say that usually with when dealing with depreciation of the building itself is, like a single family is 27.5 years that you can depreciate.
Mhm.
And how will that compensate when you actually don't have buildings attached to the land, right? I'm just trying to understand this first time I'm trying to deal with or
Yeah.
wrapping my
Yeah.
mind around taxes with MHPs. Yeah.
Yeah, so mobile home parks are mostly land improvements. Land improvements are considered 15-year property,
Okay.
which are eligible for 100% bonus depreciation. There wouldn't be that. The only time there would really be 27 and a half year property on, I guess there's some. some structural components that might have a longer class life, but like unless you're putting permanently affixed homes to the ground, that can't be removed or not intended to be removed, like a normal house, um, that's when you see 27 and a half year. But mobile home parks, like we just brought a cost segregation expert onto our team and he's doing cost segregation. I asked him the question. I asked him very clearly, I'm like, how mobile home parks, what's the deal? 70, almost, 70% or in some cases more of the mobile home park are eligible for bonus depreciation because it's so heavily land improvements. So you're not really dealing with too much of that 27 and a half or 39-year property. There might be some structural components that exist that qualify for that life, but the majority of it's going to be is going to be 15 year.
When speaking about the biggest systems like sewer and all of that, they still pretty much just go to 15, how you say?
Yeah,
15
those
years?
are typically considered land improvements.
Okay,
And that's land improvements are eligible for 15 for bonus depreciation.
awesome. Thank you. And one more question in regards to what you were saying, and when you materially participate, the hours that you were mentioning and the time, would that be specific to the to one property, or would you be able to kind of split it out through all your assets?
Yeah, that's a great question. So there's a grouping election under the real estate professional status that allows you to group all of your rental activities as one for the purpose of material participation. So most of the time, if you qualify for the real estate professional status, you're going to group all you tip not 9 times out of 10, people are going to make that election to group all their rental properties as one, so that you don't have to meet a material participation test on each and every single one of your rental properties, whether it's a mobile home, a commercial property, a single family property, or anything in between. You can group those together as one. It's considered one activity for the purposes of material participation.
Oh, beautiful. That's awesome. And when you do that, sorry, blanking in my question here.
No
Um,
worries.
never mind. You can continue. I just it
All
went
good.
away from me.
If you remember Miguel, let us know, and you can
Went away
always
from
come
me.
back to the stage. Thank you so
Sounds
much.
good. Thank you so much.
And then just for reference, we just completed a cost seg on a $600,000 property. It was a mobile home park. We achieved $450,000 of depreciation, 100% bonus depreciation from that property via the cost seg. So that kind of follows what Thomas was saying. It's an insane bonus depreciation amount on mobile home parks because of their classification.
Yeah. Yeah. People always ask me just in general, Tom, what episode, what types of properties have the most bonus depreciation? Mobile home parks are at the top of the list. The only thing that I think could really maybe top that are car washes and oil and gas, and excuse me, and gas stations, simply because there's a specific carve out that if those car washes or gas stations are operated and are set up in a certain way, that the entire amount is actually eligible for 100% bonus depreciation. It's just a weird carve out for those two businesses. I'm not really sure why they did that, but they did. So that's just something interesting to keep in mind there.
I'm not seeing any more questions in the chat here, so we'll close out shortly. I'll give everyone the opportunity to think of any additional ones for Tom here. But in the meantime, Tom, did you want to talk about what services your team offers and how you guys can help everyone on this call and then anyone watching after the fact with some of these kind of more difficult tax issues that they'll face as real estate owners?
Yeah, absolutely. I'd say the thing that makes us different or the thing that makes us stand out from most typical CPAs is we offer tax strategy and planning. So that's actually tax advice, tax consulting on what to do to reduce your taxes based on where you are today and what your goals are. So most CPAs, they'll file your tax return at the end of in April or whenever they file your tax return after the year ends, and they'll say, "Okay, cool, see you later." And if you ask them, "How do I reduce taxes?" They might tell you to invest in your 401k. They might tell you to invest in your IRA, or they might just tell you to make less money. I can't tell you how many people I talk to where my CPA just says, stop complaining and make less money if you want to pay less taxes, which to be fair is an effective tax strategy. You will pay less taxes, but usually not what people want to hear. So we help investors identify what strategies, deductions, credits you're entitled to based on your current circumstances and what your goals are for the future. And that's one of the main things we do, I think, that separates us from most average CPAs out there. Um, Now, we also do tax preparation and filing. So that's the actual filing of your tax returns. We do also help with accounting. So if you do have a sizable portfolio and you don't want to deal with the bookkeeping yourself anymore, you're tired of trying to outsource it to someone in the Philippines, we can help you with that as well. And we also recently brought recently brought cost segregation studies in-house. We hired a cost segregation expert, a director of cost segregation from a very well-known firm. We kind of brought him to our side of the equation, and now he's doing cost segs for our team. So that's phenomenal. That's how we help investors. Basically, we help you reduce taxes and gain financial clarity. And if you're a real estate investor, whether you have a mobile home park, a single family portfolio, short-term rentals, commercial, multifamily, really anything in between at this point, we've seen it. And we deal with it on a pretty regular basis. So, yeah, that's how we help people. And I saw Kyle in there. He's working with Jackson. Yeah, Jackson's great. Jackson's a great guy on our team. So good to hear that that's going well.
Oh, we got another question here. Sorry, you're not off the hook
Okay.
yet here, Tom. Uh,
Okay.
Harrison, you want to go ahead and address that?
Yeah, we got Harrison for cost segregation. When looking at the purchase price allocation across different depreciable components of the property, how flexible is that allocation in practice? Specifically, if a buyer and seller agree on a reasonable allocation and then it's supported, is that acceptable from a tax and cost seg standpoint? I get that question all the time, and I know what you're trying to say. You're trying to allocate the purchase price to certain things, like that. There's a really gray area in there, and you have to speak with your CPA to see they're comfortable with because that could be scrutinized if you were ever audited. Like with the cost segregation study, what's happening is the cost segregation, the engineer, it's an engineered study. So an engineer is going to your property and saying, here's all the components within your property. So here's this table, here's the desk, here's the lamp, here's the walls, those the sheetrock, that's structural, um, so on and so forth, and giving you a very detailed report and then telling you how much each of that is worth based on its current condition and national pricing. There's an entire like back end database and like an audit technique guide that's like 100 pages. There's a lot that goes into this to be able to break this down and make it defensible from a tax, an audit perspective. So while I hear what you're saying with the buyer and seller saying, okay, well, I'm selling you this $1 million property and $600,000 of this $1 million property is the land improvements. That only goes but so far in terms of being able to defend that in the event of an audit. So you just have to be careful there and make sure your CPA or your tax professional is on board with what's being allocated there. But a cost segregation company, I'm going to stop rambling after this, but a cost segregation at the end of the day is going to be the most defensible way to break down how much different components within your property are worth outside of having the actual receipts yourself. If you built the property and you have all the receipts that this cost, whatever, 20, this costs 200 bucks, then you have the proof to show for it, if that makes sense.
Harrison, any follow-ups there? I brought you to the stage just in case.
No, that was really it. I appreciate the input there.
Okay.
Thank you, Harrison.
No problem. We got Jeremy. Jeremy asked, do you do taxes for mobile home parks?
Straight to
Absolutely.
the point. Yeah.
Absolutely, absolutely. Yeah, we have a handful of clients here from Mobile Home Park Pros here, MHP Pros, but we also have just clients we've had throughout the years. One of our largest clients, not one of our largest clients, but we have a dentist that we work with, and he's acquiring mobile home parks every time you turn around. So yeah, bottom line is yes. Tracy Moore, how are large maintenance expenses such as a large amount of tree trimming expense? Is that CapEx or depreciated? So that's a good question. That's a good question. Um, if it is uh, okay, let me put it this way. If it's maintenance, if it's really considered like a maintenance expense, then it would be immediately deductible. It's not CapEx. But if it becomes, it can cross over depending on like how large it is and the complexity and what else is being done. It could be considered a land improvement. right? And if it is considered a land improvement, then it is eligible for 100% bonus depreciation and fully deductible. So one way or another, it's typically going to be tax deductible. It just depends whether it's truly a maintenance expense or does it rise to the level of CapEx, which is just something that we'd have that has to be evaluated on an individual basis based on a bunch of criteria. Um, and then Jeremy gave his email. So yeah, Jeremy, I'm more than happy to shoot you an email, get a call set up to see how we might be able to help. Um, but yeah, if we have any other questions, I'm happy to keep going.
Anybody else have any additional questions? If not, I've got a quick one for you, or maybe not a quick one, but you can answer it quickly. Um, in terms of LPs, right? I get this question a lot from my LPs, specifically about, when you're, even if they can materially parts, or sorry, even if they're real estate professionals, and we then go and sell a property, and they're, LPs on that syndication, the depreciation recapture will hit their balance or will hit their expense lines regardless of whether we as an organization utilize those proceeds to reinvest into another mobile home park, correct? Like unless we use a 1031 alongside them, they would then be hit with that depreciation recapture, correct?
Yeah, so what you're saying when you sell the property, are they going to, unless you use it, yeah, are they going to be hit with bonus? Excuse me, depreciation recapture? Yes, they will. When the property so basically as a limited partner, they're a partner in the general business, right? In the overall business, and they're going to be allocated a portion of all of the expenses, depreciation, income, so on and so forth, gain, so on and so forth, usually based on the operating agreement or their ownership percentage. So when it's sold, unless you do a 1031 exchange with, at the GP level and bring everybody with you, then they're going to be subject to that depreciation recapture. So the way for them to mitigate that, though, would be for them to invest in the next deal, and use the losses from that next deal to offset the gain and the depreciation recapture from the other deal. That answers the question.
So an incentive to stick around with me as a GP.
Right,
Got it.
right,
Awesome.
right, right.
All right, I'm not seeing any more last minute questions here. I'll give everybody a minute to kind of brainstorm and then we'll let Tom go. Right after this call, you should receive an email with a form to fill out where you can reach out to Tom. Tom will also, I think, be sending out a link for you guys to fill out in order to get some time in his schedule or his team schedule to engage them for services. They are fantastic. A lot of our members at the MHP Pros utilize Hall CPA and have all said fantastic things. And I can say fantastic things about Tom now. I've been working alongside him for almost a year now, so
That's good. Yeah.
um, it's been a great experience. He and his team are extremely helpful. They've also, recently added this cost seg component to their stack of offerings. I did actually, in thinking about this, I've recently done a cost egg. And Tom, I didn't even realize your team had a cost egg arm, which, I will be exploring in the future. But I would like you to kind of explain to everyone on the call, and maybe your cost egg person would be a better, person to answer this question. But the way that it was done on our end was a virtual, almost Zoom, where we walked the park and kind of pointed things out that the cost seg specialist had a question about. I know other cost segs for maybe larger parks are done in person. How does your team typically do it? What does that process look like for anyone interested?
Yeah, so we do in-person studies. So we're actually gonna have somebody fly out to your specific property and do the full site visit. That's what we do. Um, at this point, one of the things that the IRS is concerned about is they want photo evidence, right? So simple, like there's three different types of studies for all intents and purposes here, right? There's a software study where you put a bunch of information into a software and it spits out the report for you. That one's going to be the least defensible in the event of an audit and often generate the more conservative results as a result of that because the companies doing them don't want to like don't want to deal with the IRS if they don't have to. Um, then there's the virtual site visit. The virtual site visit's like someone's video, like exactly what you did. You're videoing it. They're able to see what's going on. Those are also, that at the end of the day is should suffice, at the end of the day, because it's effectively the same thing as an in-person site visit. But yeah, we do the in-person site visit. So usually what happens on our team is if you we're instead of cost seg, You'd hop on the phone with our cost seg director. He'd have a conversation with you about your property. Does this even make sense? If it does, he would say, yeah, okay, cool. Let me collect some information. He'd give you like a preliminary report, like here's an estimate of how much it's going to cost, what the results could be based on just our overall understanding of a property like yours. And then if you wanted to move forward, we'd engage, and then he'd fly out, or he'd have someone fly out to your property to do the actual site visit itself. We take all that information, and then we put together the report for you, and you get a report. It could be anywhere between 20 to 30 pages long, detailing out the breakdown of your property and everything kind of supporting that breakdown, so that if, God forbid, you are ever audited, all of the ducks are in a row.
That's incredible. And I imagine it is a huge benefit to have that in-house, just because I know when you're sending something to your CPA and, they have to read even more than they already do, it's better to have an in-house specialist who can walk them through that report rather than sending you guys that same 30-page report from another organization, and having you do that work as well. Just to clarify there, though, you guys will accept a cost seg from anybody. Despite you now having the ability to do it in-house, it is easier if you guys do it in-house, but it's
Yeah.
not that you can't accept it from another organization,
Yeah,
correct?
yeah. So if somebody went and worked with somebody else on a cost seg and they send it to us, that we still work with them, right? But yeah, we what it is, we refer out so much business to cost segregation firms. We kind of started to look at it and said, like, why don't we just do this? Why aren't we just like if like 85% of our clients are doing cost segregation studies, like it seems like a service that's core to our business. So why not just bring it in house? And we that's what we did. But having said that, we have clients who have long-standing relationships, or just for whatever reason have done a cost segregation with another firm. And yeah, if they send us that report, we'll still work with them. It's not a problem. But yeah.
Amazing. I love how you guys are becoming a one-stop shop. I don't see any more questions inside the chat, but of course, if you guys have additional questions, reach out to Tom. I'm sure he'll be more than willing to answer them, or someone on his team will. Again, after this call, you should see a sign-up form. Please click that and talk to Tom, about potential services for the 2025 tax year and beyond. Again, they provide tax strategy consultations as well as filings. So, and now cost seg. So utilize them to their fullest extent. They're a great team. I wanted to say thank you so much to Tom again for spending the time with us here today. Obviously, like this is the third time we've done it. So we just find so much benefit in having you aboard on the MHP Pro side and beyond into other classes, asset classes as well. So thank you again, Tom. Thanks for being here. Thanks for everyone for joining, and we'll see you guys on the next webinar here.
Yeah, thanks again for having me, and have happy holiday for everybody out there. So thank you.
Happy holidays, everybody. Bye.